that earnings season at last is winding down, we've heard from all the major independent media companies, Fox, Paramount, Warner Brothers Discovery, and Disney, a group that has been really beaten bloody from late July through the end of October. Coming into the reporting period, there were tons of worries about how high interest rates are going to hurt them, economic slowdown, slower economy translates into a weaker advertising market every time. Meanwhile, there are so many other sources of entertainment competing for your time, so it's easy to assume that the whole industry might be in trouble. Yet we got some pleasant surprises here, and I think it's worth revisiting which of the media companies have been able to thrive in this environment. Let's take them in chronological order. Fox reported on November 2nd this was the most uneventful quarter of the four. The company put up pretty solid numbers, driven by strength in live content, especially sports. Fox also noted that its free ad-supported Tubi streaming service continues to grow nicely, surpassing 70 million monthly active users in September, while its revenue grew by 30%. Remember, this is the rump of Fox after they sold most of their entertainment assets to Disney. Unfortunately for shareholders, the quarter didn't seem to do much for the stock. I was sure it initially rallied a few percent, but then it quickly rolled over. At this point, Fox trading below where it was before the quarter. Even the analysts didn't love it. JP Morgan actually downgraded Fox from overweight to neutral, meaning buy to hold, citing the lack of a serious long-term digital strategy. And you know what? I think a hold rating kind of feels right here. Fox certainly isn't a bad story, but it's got a lot of exposure to cable, which we know is a slowly declining industry. And I've never met anyone who's admitted to watching Tubi. Then again, they make a lot of money from news and a lot of money from sports. Fox is definitely not the best, but it's certainly not the worst. Later in the day on November 2nd, we got surprisingly positive results from Paramount Global. Now, this stock was by far one of the worst performers of the group coming into the earnings, down more than 35% for the year at the end of October. So there was a low bar. Paramount certainly cleared it, delivering inline sales coupled with a gigantic earnings beat. The strength came from Paramount's streaming business. The direct-to-consumer revenue was up 38%, including a 61% increase in the Paramount Plus streaming service, which now has more than 63 million global subscribers. More important, their streaming business has made a lot of progress on the profitability front. Management said that the losses here peaked last year, and they're going to continue to shrink. Of course, the Paramount quarter wasn't perfect. Advertising revenue was down 14% and missed expectations. Licensing and other revenue dropped 12%, also failing short of expectations. That's thanks to the strikes in Hollywood. However, the surprise strength of streaming was more than enough to offset any negatives. Paramount stock jumped 10% on November 2nd in response to the Fox quarter. Then it shot up another 15% the next day in response to their own quarter. Looks good, but Paramount's still got the worst balance sheet in the group. It needs lower interest rates and an improving ad market ASAP. Next on Wednesday, we heard from Warner Brothers Discovery, and as much as I wanted to see a huge quarter, and I really did, this was a distinctly suboptimal report. While they delivered inline sales and solid EBITDA growth, up 22% year over year, the results weren't anything earth-shattering because the quarter was supposed to be really good. Warner Brothers produced the Barbie movie, for heaven's sake, the highest-grossing film of the year, $1.44 billion in global box office. But even with Barbie, the company still lost 17 cents per share. Wall Street was only looking for a 9-cent loss. I have to tell you, I was surprised, too. Of course, that's not enough to explain the stock's 19% collapse on Wednesday. The real problem? Management said that if the advertising market stays weak, they won't be able to pay down their debt as quickly as planned. And keep in mind, Warner Brothers Discovery has a hideous balance sheet. We're talking $43 billion in net debt at the end of the last quarter, although they have paid back a ton. Now, if they're not making progress cleaning that rest of the debt up, though, the story doesn't work. In fact, it was so brutal that the negative pin action dragged down Paramount, too. It fell 8% on Wednesday, even though its quarter was good, because Paramount has the worst balance sheet in the group. God, I love a good balance sheet. These guys don't have it. Finally, on Wednesday night, Disney reported, and after years of struggling, I think that this really was the one that stole the show. While the sales came in a little light, they were still up 5%, and the earnings were much, much better than expected, up 170% year over year. This company's actually spewing cash again. Under the leadership of Bob Iger, he's come back. Disney clearly is turning itself around. Like with Paramount, their streaming business has become much less of a money loser. Hey, it's going to we think going to turn a profit in the last quarter of the fiscal year 24. The overall company's gotten a lot of religion on cost cuts. Previously, they were talking about targeting $5.5 billion annual savings. Now they're raising that to $7.5. Wow, that $7.5 billion would be huge. Thanks to that, Disney was able to give some jaw-droppingly positive cash flow projections. Now, until Wednesday night, all the focus on Disney revolved around how much it was spending, especially on streaming. But now I think Iger's really taking control of the narrative again, forcing investors to remember that once the big investments are over, Disney can have tremendous earnings power. Remember, they do have a much better balance sheet than people realize. And that means we can start thinking about the restoration of the dividend. Not big to start, but it could be a surprise. And I expect that to happen soon. And then get this. I think when I look over the balance sheet, I see the possibility of a buyback. Yes. And those are two reasons why we have held on to it for the Charitable Trust. We're going to talk about this on Wednesday. Talk about what it means to hold and what it means to fold. Disney stock jumped almost 7% in response to the quarter yesterday. Although it gave some back today, I thought it gave too much back. I think this quarter could be a true turning point for the company. Now, remember, Disney has legendary activist investor Nelson Peltz riding herd on them. So I believe that they will deliver on their cost cuts or die trying, which makes me think that the stock has a lot more room to run. I've been talking about maybe seeing $100 by year end. That's one of the reasons why we bought so much lower for the Charitable Trust. Having heard from all four major independent media plays, let me give you my power rankings. I think Disney, after this quarter, should be considered the best in show. Now, if they hit their financial targets, I think the stock could be among the top performers, not just in the group, but in the entire S&P 500. Fox comes in second. While it's the most boring story in the group, there's a lot to be said about boring, especially when it's paired with a solid balance sheet. Plus, Fox News should make a fortune next year ahead of the election. Remember, it's presidential year. There's a lot of advertising. As for Paramount Global and Warner Brothers Discovery, well, they both suffer from the same problem. They've got really terrible balance sheets. And on Mad Money, we do not like companies with bad balance sheets. We don't like money losers, and we don't like bad balance sheets. While Warner stock got killed by the negative update on its debt load, Paramount's in even worse shape when you compare the two companies' leverage ratios. At the same time, I have more confidence in Warner's CEO, David Zaslav. He is a very sharp business person than I do right now in Paramount's Bob Bakish. Very nice guy, but he's been around for a while. At this point, the business is still struggling. Doesn't seem right to me. Bottom line, after earnings season, it's worth reassessing the independent media plays because some of them are doing much better than expected. I like Disney the most, followed by Fox, then Warner Brothers Discovery, with Paramount Global pulling up the rear. Mad Money is back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.